Welcome, everybody. It's Jonathan Cisneros here at ESO Realty Incorporated. I am joined here by a very well-esteemed real estate partner, lender, friend. I can keep going down that list. I can talk so many good things about him, but Vincent Cardona here with PRMG.
How you doing, sir?
I'm so happy to have you here, my friend.
Thank you. Thanks for having me.
Tell the folks that are listening a little bit about yourself, if you could.
Sure. Direct mortgage lender, resident of the Antelope Valley community here now since Christmas Day, 1999. Been in the business about 28, 29 years. Lending's all I do. So it's my pleasure to be here. It's a pleasure to help our community.
Yeah. Thank you, Vince.
Yeah, thank you.
You know, you've been saying 28 since I met you, right?
You know what? That's probably still my 22nd birthday as well. Yeah, don't make me do those numbers. Don't make me do those numbers.
Yeah, you've been doing it for more.
I've been doing it for quite some time.
You broke the 30 mark.
Oh yeah, I'm probably 30 years in the business by now. Yeah. Oh yeah,
man.
But hey, still 22.
No. And I know it is, and I know it's true, and I know you've done a lot. Because
thank you.
Every time I work with you, I learn something, and everyone around me learns something.
But you know, it's important to understand that that's always been one of my key objectives. You know, for me, the information aspect, the education aspect is most important, simply because I believe, unfortunately, in our industry right now, there's more that can be done to help educate our consumer base, to make them aware of what actually goes on our side of the fence, so to speak, because for so many years, consumers have not been getting the key points of information that they need to make a sound financial decision for them and their families. You know, and what we need to understand is what we do is very important. You know, I've told you this 1,001 times. Your dream job is not my dream job. Your dream car is not my dream car. But we all do share that quote unquote American dream. You know, we dream of home ownership. Yeah. So, you know, our job is very important in that what we do helps families, individuals achieve and realize that dream. So it's important that we not only offer our expertise, but also our guidance and the years of experience and information that we bring to the table. I think that's key. Yeah. You know, I think that's what separates the, you know, the button pushers from the true people that are helping the members in our community.
Very well said.
You know, you got to be able to get in there and roll your sleeves up and really help keep our community and our peers informed.
It's true.
Got to keep people informed.
I mean, it's even in my slogan too, and it's something, you know, I've learned from a lot of people, including you. You got to be beyond conventional and beyond ordinary.
Oh yeah. Yeah, but more than that, you've got to be hungry for the knowledge and information, because our industry is ever changing. You know, one of the key things that I never try to fall into that rut of thinking that just because I have been doing it for 30 years that I know everything. You know, for example, our topic of today, you know, the Dream for All program. This is unlike anything we've ever seen in the way of down payment assistance, especially from Cal HFA. So if you become one of those, I've been doing this forever, you can't tell me how to do what I do, then, you know, who are you really serving other than yourself?
It's true.
So, you know, we have to be ever learning, ever in the pursuit of knowledge and experience. You remember what we always say, you know, the only thing that compensates for a lack of experience is an abundance of knowledge. That's it. It is. So you got to keep learning. In our business, you got to keep learning. You've got to be able to adjust and adapt on the fly. Yeah. So, you know.
I love that saying, man.
Oh, thank you, man.
Because I hold it with this baby face that started almost 10 years ago.
You know, it's tough.
It was tough.
It's, you know, again, you're trying to advise people on the single most important purchase they're ever going to make in their lives, you know. And we don't know what they've gone through to get to this point. You know, as far as we know, they could have been saving up for 10, 15, 20 years. And so it's so easy to spend other people's money.
It is.
You know, so when you have to stop and say, okay, let me explain to them why I'm offering the professional advice that I'm offering. You don't just snap your fingers and tell people to do something. You know, you have to support and reinforce the decisions and advice that you're giving from a professional perspective. You have to let them know why you believe that to be so and why it is your professional opinion. And when you can get that point across to them, then that's when you're really helping. Yeah. You're making a difference. And that knowledge is key to, you know, if you're going to offer sound advice, you better know what you're talking about.
Absolutely.
Yeah. You know, if you don't know, don't say, don't speak. Don't speak. If you don't know, please don't speak.
Yeah. Very true. Very true. Well, like you said today, talking about these down payment assistance programs and the Dream for All, it has made huge ripple effect right now. Huge.
Indeed.
And I think you came in prior to us getting ready, and you were showing me your phone, and you were all I saw.
You know, I hate those. I hate those words like unprecedented, but this really is unprecedented. I've been unable to answer my phone for the last 2 days. I've literally had to put in my voicemail, sorry, not taking calls right now. I'm focused on processing applications. Just since I was designated once again Cal HFA preferred loan officer,
which not every lender is, right?
Well, you've got to have a commitment to the Housing Finance Agency. You have to have a certain amount of production, and you have to keep a skill set, you know, and you have to stay abreast of all the changes that are happening with the programs. So, you know, I was very proud and honored to be selected again. But as soon as that hit the website for this particular program, the calls started coming in 20, 30, 40 a day.
Wow.
Well, then immediately after the calls, then the online applications started coming in. And I hold myself to a very high standard. So for every application that comes in, you know, I better have a response within 24 to 48 hours.
Yep.
Those turn times right now are almost tripled, which has caused me once again to not answer phone calls at the moment and get through the applications. You know, as I walked in today, I was letting you know that I was still working on approvals from documents that were uploaded Friday afternoon, and here we are Wednesday afternoon. So I'm already on lead number 158 for just this program, and that's 158 leads in just 2.5 weeks. Okay, now the difficult piece of that number is understanding that even those that aren't eligible or may not even be in a position to complete an application right now still require that time and information. So even though there are 158 leads that have come in, I may be on application 80 or 90, you know, but it's important that just because you know 2 minutes into a conversation that somebody doesn't qualify, that doesn't mean they don't deserve your time, information, and education on how they can position themselves to qualify in the immediate future.
Correct.
You know, so I think that's important to keep in mind. That
because it's so easy to say, sorry, you can't, you know, and no. Sorry, have a great day.
Correct.
And you don't do that. You're not about that.
No, we've always, me particularly, I've always shared this with you as well, because we've been working together for years now. My answer is never no. It's just sorry, not right now. But here's what we can do to position ourselves in the future. You know, you and I have had clients that we work with 6, 7, 8, 9 months before realizing that dream of home ownership. So it's never, you know, sorry, thank you for coming, have a nice day. It's okay, let's sit down. Let's talk about the steps you need to take to position yourself for a point in the future. So with all of those phone calls, even though I knew a couple of minutes in they didn't qualify, you still have to go through the process. So regrettably right now, just to even get caught up with the applications for this program, I haven't been taking calls for 2 days now.
Yeah, it's a lot.
It's a lot. It's a lot of work.
Can you talk about, let's say here, some basic eligibility criteria?
Very good question, especially because this is phase 2 for the California Dream for All Shared Appreciation Program. So it's important that you hear that title, because there are a lot of bits and pieces of information in the title for the loan program. So it is the California Housing Finance Agency, what we call Cal HFA, the California Dream for All Shared Appreciation Loan Program, okay, or Dream for All for short. That's what everybody's calling it right now. Now this is phase 2. And with phase 2 comes some very important changes with respect to eligibility. Primarily what's being called the first generation home buyer requirement. Okay? So during phase 1, all you had to be was a first time home buyer. Okay? And first time home buyer, as defined by the state of California for the Cal HFA, is simply someone who has not had an ownership interest in their primary residence for the most recent 36 months. Now that's important because we've actually been able to get people in as first-time home buyers with other down payment assistance programs for individuals that do have an existing investment property. As long as we can prove that they have not been utilizing that investment property as their primary residence for 36 months, those individuals are technically still first-time home buyers. So that's important, guys. Okay?
Correct.
Don't believe that just because you've had an investment property in the past that you're not a first-time home buyer.
Yep.
So with the Dream for All program phase 2, now not only do you have to be a first-time home buyer, everyone on the loan must be defined as a first-time home buyer. But at least one applicant on the loan must be a first-generation home buyer. Now listen to the subtle differences. Now with a first-generation home buyer, there can be zero ownership interest in any real property. And I say real property because we're not talking mobile homes here. Okay, so any real property for the last 7 years. So no ownership position whatsoever for 7 years. Then that individual, his or her parents, cannot currently own a home. Or if his or her parents are deceased at the time of their passing, did not own a home. Okay. Now it's also important to understand that first generation requirement is completely null and void if at any point in your life you were in the foster care system. So if you were raised as a foster child, that doesn't pertain to you.
That is a great point.
Very important to keep in mind. But the common question that I get quite a bit is, well, you know, my parents own in Brazil or my parents own in Mexico.
Yes.
The home ownership that we're talking about is domestic home ownership, okay? So even if your parents own in another country, that does not disqualify you. So you are still eligible as a first generation home buyer. So that's pretty much it. First time home buyer, everyone across the board. But if you have multiple applicants, so let's say husband and wife, right? Husband is not first generation, but the wife is, they qualify for the Dream for All. So as long as one of them on the application can achieve that eligibility of first generation, they're good to go.
And both incomes will still be accounted for.
Both income and debts.
And debts, of course, yes.
Income, yes. You take the good with the bad. But yes, as long as one of them can achieve that requirement, then you're good to go.
Wow.
Okay. So that's one of the most significant requirements is that first-time home buyer and the first-generation home buyer. Now, in addition to that, you know, we have the typical credit, income, asset qualifiers. Every loan is fundamentally based on CIA, credit, income, and assets, okay? So it's important to keep in mind that unlike the My Home, the Dream for All is only offered as a conventional loan product, okay? So there is no FHA model or FHA option for this particular program. So as a conventional loan, we're going to follow conventional loan guidelines. Okay, so the minimum credit score required by Cal HFA for this program is 680 and up. Okay, so minimum credit score 680, first time home buyer. Income is also lower than the standard Cal HFA income limits. So it's important to understand, just to put that into perspective, for the My Home program, the maximum income in LA County would be $194,000 a year, total combined income between all the applicants.
Understood.
But for the Dream for All program, LA County, that's reduced down to $155,000. So it's important to understand that the Dream for All program in and of itself is unlike anything that Cal HFA has offered. And I'll give you one more example, okay? So with the My Home offers FHA and conventional down payment assistance for first-time home buyers. If you have your own funds available, you are unlimited on the borrower contributions that you can put in to lower your principal starting balance. Okay, so if you get 3.5% assistance for an FHA loan, you can come in with another 10% down of your own funds. Okay, lower your principal balance, lower your payment, maybe even increase your buying power. Well, with the Dream for All, you're capped at 5% of the purchase price of your own funds to be used to increase your down payment. Okay, so let's say you're buying a $500,000 home. The Dream for All portion of the down payment assistance, that would be $100,000, 20% of the purchase price. But 5% of 500 is only 25,000. So you would only have the ability as a home buyer to put an additional $25,000 down to increase your down payment and lower your principal balance. So it's not like, I've had some clients that had $100,000, $150,000 in the bank. They're like, can I throw all of that towards the principal balance and reduce it? Unfortunately, not for this program. Again, it's important to keep in mind who this program was intended to help. You know, and
non-generational homeowners.
Correct. And how many of those really have $150,000 at their disposal?
Correct. And it makes, truthfully, it makes sense.
Yeah.
I mean,
but you would love to be able to say, by all means, if you've got the funds and you wish to lower your monthly payment and increase your equity position, please.
Like the My Home program.
Correct. But unfortunately, with the Dream for All, you're capped at a total 5% of the purchase price in your own funds that can be used to increase your down payment.
Gotcha.
So some of the nuances of the program, but other than that, again, with credit score above 700, you're looking at a maximum debt to income ratio of 50%.
Okay.
You know, the beautiful part about this program is...
Sorry, can you say that one more time? So if you have your FHA Can you, if
No,
you
no,
could
no.
talk on,
It's conventional.
and if you could talk on the down payment assistance for the My Home, the Dream for All, and standard.
Gotcha.
What would be the different DTI limits?
Well,
pertaining to
the DTI limitation is driven by the credit score.
Mm-hmm.
Okay, so typically across the board for their products,
Mm-hmm.
what CalHFA says is that the maximum debt to income ratio on the back end, which would be the PITI payment, so principal, interest, taxes, and insurance, plus PMI if applicable, plus any debt liabilities that appear on the credit report, divided by the gross monthly income, and that gets you your back debt to income ratio, right? So literally the house payment plus any payment that shows on your credit report divided by your monthly income, that's your back end DTI, okay? So across the board, 45% is the maximum DTI for CalHFA products. However, if you have a credit score of 700 or above, they allow you to push that to 50%. So the better the credit score, the less the risk, the lower the risk, the increased buying power. So one leads to the other. Okay? And it's similar with the Dream for All program as well. So as long as you have that credit score of 700 or above, you're able to go to a maximum of 50% debt to income ratio.
Gotcha.
Okay? Which is important because when you look at what the Dream for All program is and what it was intended for, it's important to keep in mind that any mortgage product whatsoever, when used properly, can be beneficial. All right. This program, its key objective was to tackle one of the biggest obstacles that potential homeowners are facing today, and that's the factor of affordability. I mean, we're beaten over the head with a bat in the media every day. Everything is affordability, affordability, affordability. They're ringing that bell until the bell falls off. Affordability is one of the biggest obstacles. State of California, we know appreciation, home prices going through the roof, interest rates as well, some of the highest rates we've seen in decades, right? So how do you increase the buying power? That's what this program tackled. How can we as a state-funded agency get in there, roll up our sleeves, and help these people achieve home ownership? So because it's a conventional model, that 20% threshold is important because although it says can be used for down payment and or closing costs, it is ultimately the goal that every single penny of that down payment assistance will be thrown at the down payment to eliminate any requirement for PMI. So let's go back to that scenario, that $500,000 purchase scenario, right? All you have to do is look at our local neighborhood here in the Antelope Valley. One of the biggest obstacles we face is, I'm only qualified to 425,000, but where we're looking to buy, the starting threshold is 525, 560. Well, you can actually achieve that target purchase price with this program and still be paying a monthly payment that's more associated with the purchase price that you were qualified for. So imagine taking that $500,000 loan scenario, right? You throw $100,000 at the down payment. So you have a starting principal balance of only $400,000, right? But then you've also eliminated the PMI. So when you look at a typical entry-level payment for a first-time home buyer for conventional, you and I both know that's only 3%. So on a $500,000 house, you only need to come in with a $15,000 down payment, and you qualify for a standard conventional first-time home buyer program, right? But then your loan amount is $485,000. But not only is your payment now based on a $485,000 principal, but you also now have PMI, which depending on your credit score can be anywhere from 0.40 to 1.13. Depending on how strong or weak your credit is. Because what a lot of people don't understand is the PMI is also driven by the risk factors associated with the loan. So the higher the credit score, the lower the PMI factor. So imagine not having to even worry about that. You've got 20%, you just threw it at the purchase price. So you're at an 80% loan to value. Now you've got no PMI, and your principal and interest portion is being calculated on only 80% of the purchase price. So what you're doing is you're giving that person, as I like to, me and my analogies, okay? You're driving off the lot with a Mercedes-Benz for the price of a Toyota Camry.
Exactly.
That's, from an affordability factor, it's giving you the ability to increase your buying power with maintaining a monthly payment that you will still qualify for at the higher targeted purchase price. That's simply what this program was intended to do. The program was intended to allow you to live and grow in a home that you did not necessarily qualify for the actual payment at the time.
Mm-hmm.
Okay, so that leads to the most common question from most potential homeowners is they say, okay, why would I want to use this program if I am forced to at a later point share in the equity?
I was going to ask you, what are the
Yeah.
things that
cons?
aren't talked about right now? We're
Yeah.
going on the other side,
Yeah,
right?
yeah. So one of the most important things to keep in mind is this is an equity share program.
Mm-hmm.
Okay, the My Home is not. The My Home is whatever they give you, that's what you end up paying back when you sell or go to refinance the house, right?
Mm-hmm.
With this particular loan, let's go back to that $500,000 scenario. Okay, I want to stay on the same playing field so that we can not confuse
Yep.
the numbers and the data. Okay, so we've got a purchase price, $500,000.
Okay.
The Dream for All assistance is $100,000.
Mm-hmm.
So your principal and interest payments are starting at a starting loan balance of only $400,000. Okay, so you live in the home for 3.5 years. You're now going to sell that home, right? Well, let's say you have $100,000 in equity now in appreciation, and you bought the house at $500,000, and you now wish to sell it at $600,000. Okay, so it's important to understand that initial Dream for All assistance of $100,000 is paid back at zero interest. So you will never owe them $1 more than what they gave you for the Dream for All loan. Okay, so you received $100,000 right off the top. That $100,000 has to go back to the state of California.
Mm-hmm.
But your appreciation, what you grew in value, was $100,000 because you bought it at $5,000. You're now selling it at $600,000. 20% of that is owed to the state of California. So 20% of $100,000 is $20,000.
Okay.
So in this scenario, if you bought the house for $5,000, you're selling it for $6,000. $120,000 would be paid back to the state of California. Okay, so that's a tough pill to swallow. Imagine if you're trying to explain this to someone who's never owned a home before. They're going, wait a minute. If I bought it for $5,000,
Mm-hmm.
but I only owe $4,000 right now, and I'm selling it for $6,000, how is it that I'm not making $200,000?
Yeah.
Well, it's important to remember that down payment assistance was there in the form of a silent second.
Yep.
Okay. So even though you started with a $400,000 loan balance, because that's what you're seeing on your mortgage statement every single month, you actually owe 100% of the purchase price. You got into that home, you're paying on only 80% loan to value, but you didn't put a penny out of your pocket
Correct.
to get to that equity position.
Correct.
So got to pay back that Dream for All. And then on top of that, anything above that original purchase price, 20% of that is going to be owed to the state of California. So that's how the Dream for All shared appreciation is defined.
So 20% above
of the appreciation only. So if you bought it for $5,000
Mm-hmm.
and you're selling it for $5,000, there's no appreciation. So the only thing the state of California would take would be their
The
original,
20%.
the $100,000.
Understood.
Correct. So
Understood.
that's how it works.
Yeah.
And here's another thing to keep in mind,
Mhm.
because this was something that was struggled with as well during phase one.
Mm-hmm.
Okay. So also, we know that interest rates are pretty high right now. Okay. I share this openly with everyone. I'm a huge advocate for Cal HFA and their loan programs for a very particular reason. Okay. When you look at down payment assistance programs across the board, Cal HFA has simply the most affordable interest rates out there. This is something you and I talk about constantly. Okay?
I've seen it.
So whenever you look at the national averages for interest rates, and then you look at what is being offered by Cal HFA that day, okay, 99.9999999% of the time, Cal HFA's rates are lower than the national averages.
Correct.
Okay. And so it's important to keep in mind that there are no adjustments for added or additional risk factors that you would see in typical direct mortgage lending. And here's what I mean by that. So let's say you're buying a condominium in San Fernando, right? And let's say you only have 680 credit. Okay. Well, a lot of people think that 680 is pretty good credit, and it is. When you look at averages, right? But it's important to understand that if you're looking at 680 credit, you're actually on level 4, or depending on the pricing model, you could be on level 5 as far as credit scores go. So not only would you be facing increases in rate based on your credit, but typically for buying a condominium and the added risk factor in that, you could be looking at an additional 0.5 point. So let's say par or starting national averages were at 7.0 for conventional loans, standard conventional loans. Yeah, but that's at 750 credit or higher. Our guy, again, has 680 credit, right? So if our guy was buying a condominium with a standard conventional and national average was starting at 7.0, our guy could be looking at a 7.875.
Plus a higher PMI.
Plus
with the lower
correct.
score.
But you take that same scenario to Cal HFA, there's no price adjustment for subject property type.
Yeah.
So whether you're buying a stick-built single-family residence or you're buying a condominium, the rate is what the rate is.
Yep.
Whether you're 680 credit or 800 credit, the rate is what the rate is. They don't do any price adjustments.
Yep.
So the beautiful thing about Cal HFA is it's a pass-fail model. They do not discriminate. If you qualify, you qualify. They don't say, oh, you're more qualified. No. You qualify, you qualify.
Yep.
So if you have a 681, you know, it's nice to have 800. I mean, bragging rights are bragging rights, but it's not going to affect the loan.
Gotcha.
So it's important to keep in mind that for that simple reason right there, I love Cal HFA because across the board, their pricing and availability of interest rates are very, very aggressive. You know, they're really in it to help. Okay. So when you look at the Dream for All program, that's already giving you the benefit of no PMI, principal and interest payments calculated on only 80% of the loan value, but then you're getting an interest rate out the gate that's lower than the national average, and you just got $100,000 in down payment assistance using our example again. It's a win-win.
Yeah.
That is a win-win, brother. Those are factors right there that I think are not spoken of enough in understanding, you know, the driving goal and objective for this program was to increase affordability and lower the monthly payment for a family. You're getting a lower than average interest rate, regardless of your credit score, as long as you qualify. Okay. So in other words, whether you have 680 credit or 800 credit, you're going to get that same rate. You're going to get the down payment assistance. You're going to avoid PMI. You're good to go.
Gotcha.
So that's where, you know, you have that family that's saying, you know, we only qualify at 400. We want to buy a $550,000 house. This is the program to go for.
Got it. Good stuff. I do have a question.
Yeah, fire.
So last year when they were bringing out the minimum required credit score for Cal Half, it could be accepted or approved. I had heard that if you had a, let's say, tier 1 or tier 2 level credit score, 750, 720 and above, that you had to pay higher cost. Now, I'm not sure if that was some entry cost or higher mortgage insurance. I don't know what exactly it was. But
so what you had heard in the industry is the more well qualified you were, the more expensive the loan was going to be?
There was an extra fee tacked on. It was a one-time fee they had to pay.
No.
Okay.
Mm-mm.
Because there was a huge uproar about it, and everyone was all upset.
that you know, you have what are called LLPAs, okay, loan level price adjustments, but that exists in conforming products and without down payment assistance, because most of those LLPAs were specific to second homes, vacation homes, and investment properties.
Got it.
So the irony of that was if you're doing well enough for yourself and you were able to afford an investment property or a vacation home, it was going to cost you more. And it was going to cost you more because they were taking that added premium and passing it down to the assistance programs that were intended to help low to moderate income or more qualifying challenged individuals.
Understood.
So yeah, there was quite an uproar because when you look at that, again, going back to the whole American dream, hard work is supposed to be rewarded. And the LLPAs were seen as punitive. You know, they were seen as, okay, I'm doing better off for myself. I'm working my tail off. You know, I've got great credit. I've got good income. I can afford a vacation or a second home. And instead of me getting the lower interest rate, there were price adjustments to those interest rates, and they were quite costly.
Thank you. That's what I had heard. Thank you.
So that relates to second home and vacation homes, those LLPAs. That wasn't for Cal HFA or the down payment assistance. What it is, it's the letters.
Contorting
it's the letters and the acronyms. You know, we speak in shorthand.
Yeah, because right now you said LLPAs, and I'm thinking,
and you heard DPAs.
Well, no, I was going to say, are we talking about lender overlays?
No.
And lender overlays are whole.
Yeah,
Figured.
Loan level price adjustments, those were coming from the governing bodies.
Got
Okay, Fannie Mae, Freddie Mac, things of that sort, and those are at the loan level, and they were for everyone across the board.
Wow.
So when we're, in order for us to survive as lenders, we have to be able to survive in the secondary market. Okay, so we have to be able to close deals that we can sell and still turn a profit. That's what keeps companies like direct mortgage lenders or even brokers in business. If the loans aren't making money, it's difficult to keep your doors open for business. And I think that's one of the biggest misconceptions, and what I see is an unjust reputation that a lot of these down payment assistance and bond programs have with people like myself. Okay, so I'm a lender. Okay, so it's my job to find the mortgage product that best suits my client's needs. I'm not supposed to be driving the business in any direction whatsoever. Okay,
It's true.
so although I have both my personal and professional opinions, okay, because I share openly, the Cal HFA My Home is the loan program that I use for my own daughter. I'm such an advocate that, I saw it was as a perfect fit for my own family. Okay, so keeping that in mind, I have a personal and a professional opinion. However, when looking to offer solutions for a client, you're supposed to look at all options. You were never supposed to drive the car with blinders on. Okay, and you have a lot of people in the business, unfortunately, that see these bond programs or assistance programs as extra work, that are going to take longer to close, that are harder to qualify people for. And regrettably, one of the sad truths in the industry is you have companies that simply don't pay out the same level of commission for these bond loans as they do for other loan products.
This is true.
So, you have people in the business that say, why should I work twice as hard for half the money?
Yeah, yesterday we were talking. I sent you a text, and it's so many of them. I don't want to touch it. The workload's too big. I don't want to do this. And to me, I just hear, I don't know. I hear excuses.
That's a sad part. But we have to, if we're going to share this information with consumers, we have to pull the curtain back and show them the truth. There are professionals in our industry that say, oh, I don't offer that product, or my company doesn't offer that product. And then you look up, approved lenders on the Cal HFA website, and their company name is clearly listed. So it's not that their company doesn't offer the program. You have some people that aren't advocates of the program and will flat out lie. I mean, let's call it what it is. If you're saying I don't offer that program and you know that your company does, that's a lie. It's an outright lie. So it's unfortunate that some individuals view these products as a burden, because they are a lot of work, and you have to know what you're doing, because if you make a mistake, it could cost you your ability to close that escrow.
Absolutely.
And you already know what our professional relationships are like.
100%.
You fall short for your real estate partner, your phone stops ringing. But imagine what you did to that family.
And I've always said that you're working for two. You're working for two
and
all the time.
And the whole thing is, it's a disservice to the client. Because I've told you for years, the worst thing you could do is offer false hope. If you're going to tell somebody they're approved, do your homework, due diligence, make sure you know all the guidelines, restrictions for this program. Because I hear this all the time as well. Oh yeah, I've done a ton of Cal HFA. I can do the Dream for All. It's totally different. The My Home is completely different than the Dream for All. The requirements, for example, phase 1, lenders did all the registration and locking for the clients that were approved for phase 1 of the Dream for All.
And how long did that last?
11 days.
Okay.
So it's important to keep in mind that during phase 1, it was expected that those funds in that program would last for 6 months. Okay. It lasted 11 days. Okay. You and I were here in the office when my client missed it by 45 minutes.
That was not a good day.
Not a good day. So for phase 2, Cal HFA said, how can we stop this without calling a duck a duck? That was to get the clients involved. So with phase 2, there is a borrower registration portal. Okay. So the pre-approval process is going to consist of a standard pre-approval with a lender like myself. We're going to do full credit, income, and asset analysis. We're going to verify via the automated underwriting system that they get an approve eligible. We're going to factor in the 20%, because we're hoping and praying that our clients are lucky enough to get that 20%.
Okay.
So we're going to factor all that information in and give them their pre-approval. Okay. We are going to provide them with the pre-approval letter, but then the borrower themselves, the applicants themselves, are going to go directly to the CalHFA website. And it went live this morning at 8 a.m. It's a registration portal that can be reached in the home buyer section of the CalHFA website. And you go in there and you simply have to fill out the registration information, throw your hat in the ring, so to speak, upload your pre-approval letter proving that and a pre-approved CalHFA lender processed all the information. It has the parameters of your pre-qualification.
I think that's a very good point, because how many lenders are going to be able to do that on time with maybe other deals they're doing? So a lot of weight, it goes on you.
A lot. And again,
After
keep in mind that this is just the hoping and praying portion. Okay. So the borrower will go in, upload that pre-approval letter, upload their ID, proof of residency, answer the basic information about his or her parents, to determine the eligibility as first generation, right? And then you wait. And then come April 29th, that portal goes away. So this registration period is only going to be available for 26 days, but it's going to stay open until the 29th at 5 p.m. Okay. On the 29th at 5 p.m., that portal closes. Now, the state of California is expecting to take anywhere from 10 to 15 days to finalize the random selection or lottery process for the selection and disbursement of the vouchers. Okay. So people that are selected or that win the lottery will be notified sometime between May 10th and May 15th, right? Now, here's the thing. This is the beautiful part, okay? With phase one, they had nothing in place to replenish funds that weren't used, okay? So the reason why they ran out of money in just 11 days is because there were so many lots and registrations that were executed but never closed. So there was money left on the table, millions and millions of dollars of money that was left on the table. However, they did not have anything in place to replenish those funds and offer them fairly to the people that were already in line. So again, going back to my situation, my client missed it by 45 days, 45 minutes, forgive me. But we turned and walked away. We didn't stay in line because there was no line to stay in. We were told the loan product has gone away. So imagine if they threw money back in, but somebody else got access to the money instead of my clients that were next in line. So they wanted it to be fair. So in order to keep it fair, they came up with a pretty good solution for phase two.
I agree.
So for phase two now, you're going to get your voucher, and it's going to be good and valid for 90 days. Okay.